AI investment is powering the U.S. economy in a number of ways. Could the spending increase even more than it already has and lead to good things for growth in the U.S.?
You have a lot of reasons to be really bullish about the U.S. stock market and about AI investment. Today on the Altimetry Authority.
Stock earnings and favorite pastime.
So let me just say, earnings
Wall Street.
It's 2.5x because their compensation goes up.
Wall Street's wrong again.
Last episode, we talked to you a bit about why GDP growth wasn't as good as everybody thought this quarter. And in fact, it might not have been plus 3%. If you really want to look at GDP, it might have been closer to, plus 1.5 or plus 1.4. The reality, though, is if you look underneath the hood, there's something really, really important going on that has a reason for you to be very, very bullish, actually, about investing in the U.S. stock market, whatever you think about different parts of the U.S. economy. And it's what I heard somebody say, Joel, and I love this. They called it a mini wartime economy, but the ships are data centers. And so everybody, what do we mean with this? Well, if you look at since ChatGPT was launched, we're almost at a point now where investment in data center has as big of an impact on the U.S. economy as office construction, which is staggering when you think about how much office construction is really a key thing for regional banks, for local banks and everything, and how much people have been talking about it being a key part of balance sheets that everybody needs to worry about. That gives you a context on just how big that is. And AI investment is starting to become something that rivals that. And you look at it, there's plenty of other ways to look at it too. One of the things that we talked about on the last call was this idea that the consumer is under pressure. Well, guess what? We're at a point now where the consumer may be under pressure, but AI investment is so strong as a contributor to U.S. GDP growth that now it actually is starting to fill in the hole that we have for the consumer. And this is the really interesting that's kind of starting to play out, everybody, is what we're really actually starting to see happen is we've got this situation where the consumer actually may be a drag on U.S. GDP, but AI may be filling it in. And by the way, just not for nothing, this is not something, Joel, that we just realized. Everybody, we have been talking about the idea that what we still call the supply chain supercycle. We used to call it the Capex supercycle, Joel, if you remember all the way back in the day. But back since 2022, we've been talking about this idea of supply chain supercycle, which is that U.S. corporates were going to be reinvesting in themselves because we were needing to centralize things back in the U.S., rethink how we're drawing supply chains and everything else. And what AI really is, everybody, is just a turbocharger of that in terms of our race to invest in the United States. And that just tells us that what we're seeing over the last 3 years that is accelerating now is possibly having the opportunity of really filling in a lot of the gap for the consumer, and a reason for, quite frankly, nobody to be really bearish about investing in the U.S. stock market when 2/3 of U.S. stock market cap really, you could argue, is more exposed to AI investment than it is exposed to consumer. And just to put this in perspective, this is just as reported numbers. We're going to give you some more detail using our uniform accounting numbers in a second, but just using as reported numbers, here is how much AI investment has grown over the last 2 years. AI-driven data center investment has gone from basically $150 billion in 2023 to almost $400 billion forecasted in 2025, which is staggering growth. But it gets even more telling when you look at it from the perspective of uniform accounting. And right, Joel, because there's a lot of stuff, Joel, you would agree, that gets missed in that number that they were throwing out there, right?
Yeah, one of the big problems for measuring, growth, true capital expenditure, is GAAP accounting allows for all kinds of off-balance sheet assets. I mean, imagine if a company says we could spend $100 million on buying this thing, which would show up as a capital expenditure, or they could lease it under certain terms, the asset stays off balance sheet, and they only spend $10 million or $8 million or $5 million on renting the thing that would have cost $100 million. R&D is off the books. There are a number of other items that when a company's investing in its future and its growth, things like working capital, things like land and other areas may or may not show up depending on how they're financed for the business. So one of the things that we do is we say we're going to capture everything that the company's spending, not just the GAAP accounting Capex, but the uniform accounting based true capital expenditure. And then you see some gigantic numbers, much, much, much bigger than get reported by the as reported Wall Street, financial media complex.
Mm-hmm. Yeah, and for perspective, everybody, this is exactly what we're looking at here, what Joel talked about, the idea of looking at what real numbers are in investment. And what this is right here, this is important because this is different necessarily than the other data that we just showed you. This is growth Capex, meaning R&D, leases, and hard maintenance and hard investment Capex. That is meaning above what these companies need just to keep on investing to keep the wheels on. What is the growth Capex for the hyperscalers, right? So that's Microsoft, that's Alphabet, that's Amazon, that's Meta, and that's Oracle, right? The big five, if you will. And what you can see is these companies are plowing $300+ billion a year in growth Capex, not in maintenance Capex, which also, by the way, shows up in GDP because that's just ongoing investment. This is growth Capex that they are plowing into their businesses. This alone, if you do the math, that's 1% of GDP. Actually, a little bit more than 1%. It's 1.5%, 1.25 to 1.5% of GDP of just growth Capex we're talking about here in this investment. And the really important thing, and those of you who have been a viewer of this of the show for a while will know this chart. This is not something that's going to be an issue. What this shows you is what is the true real, when we make all those adjustments that Joel just talked about, what is the real earnings power of these businesses? And what it shows you is these companies generate a tremendous amount of profits. And with all the tremendous amount of profits that they generate, they're not going to have any issues continuing this investment and this huge growth investment that is going to power the U.S. economy going forward. And so when we look at it, and this is the really exciting thing, is you might say, hey, there's no way that they can keep this up. This is not something that possibly could run. And in fact, if you look, we're kind of at the levels that we were at the end of the dot-com boom and Y2K investment. But just to put in perspective how big this investment scope can get, people have compared the importance and urgency of investing in AI as how important it was for the economy to build railroads in the 1880s and before and after. You had periods of time where Capex as a percent of GDP was 6% of GDP back then. Now, I'm not calling for that to happen, but if you get anywhere along that, which is, and you look at the commitments that OpenAI is talking about in terms of spending, what Meta is talking about, what XAI is talking about, what every single one of them is talking about, this number is only going up. It is not going down in terms of the investment. So anybody, when we talked last episode about how GDP growth is under pressure because of government and the consumer, just recognize the show hasn't even started for AI investment, and there is a lot more room to run. So don't be panicked about payrolls and the consumer. Don't be panicked about those things. Know that if you're investing in the right parts of the US, parts that, by the way, Joel, right, we love in terms of everything that we focus on for the AI ecosystem, the supply chain supercycle, there is a lot more room to run for this economy. And so everybody, if you enjoyed that, hit the like and subscribe button. And thanks so much, and we'll see you in the next episode of Altimetry Authority. Thanks, everybody.